This is in the functional currency, when you need to adjust your plus minus in the functional currency or subsidiary. After doing adjustment, then we talk about translation. Translation is to show in another currency. It's not to adjust in another currency. It's not to record in another currency. Depreciation is an expense. Expense will be translated using average rate. The plant assets at the year end is the assets. Assets will be translated using closing rate. Average rate for the year is equals to 1.88. The closing rate at the year end is 1.82. Multiply. Hong Kong dollar is equals to 5.6. The closing balance for the plant assets to be depreciated over the remaining 4 years is equals to 21.8. The next step is to calculate the balancing figure. 28.5 minus 5.6 is equals to 22.9. 22.9 we must adjust to 21.8. There's a difference of 1.1. It's a minus. Reduce assets. It should be a loss. This represents a translations loss. This year is a loss, next year may be a gain or loss. This is just a differences. At the start we translate using 1.9, at the year we translate using 1.82. When it comes to next year, it may be translated based on 2. The differences will be there. Every year we do consolidations. These are differences we do not recognize in P&L. We have a differences of 1.1 translation loss. This translation loss will be recognized in OCI. Depreciation is recognized in P&L, but the translation difference is recognized in OCI. We must pass an entry for this. Entry 2. Second entry is to reduce the plant because of depreciation, to reduce the plant because of translation differences. Debit profit and loss for the depreciations, 5.6. Debit of OCI, translation loss, 1.1. Credit PPE, which is equals to the total of these two, 5.6 plus 1.1 is equal to 6.7. This entry you have to pass for number 2. Show this on the worksheet. We must adjust the plant for 2 items. First, we must reduce because of depreciation to P&L. Second item is to reduce the plant because of translation loss. Total adjustment of plant is equal to 6.7. Entry number 3 is to adjust goodwill. Earlier on, we took out this amount and show it as working 2. First, we must account for the depreciation adjustment. The second one, we have to do the translation differences. The next item that we have to do is goodwill. We take the goodwill down again. Number 3, goodwill of BBL. It must be expressed in the functional currency of the subsidiary. At the acquisition date, the goodwill is equals to 5. And the first time we do translations, it will be translated using 1.9, the HR rate, equals to 9.5. This is the goodwill at the acquisition date. The question mentioned that there's impairment loss. Impairment loss of goodwill must always recognize in P&L. Do we adjust based on $5 ringgit, or do we adjust impairment based on $9.50 Hong Kong dollar? You must always adjust in functional currency, because this is an asset of the subsidiary. If it's an asset of subsidiary, it must adjust in the functional currency of subsidiary and not the presentation currency. The question mentioned that the goodwill was impaired by 40%. 40% of 5 is equal to ringgit 2, closing balance, carrying value of goodwill at 31st December 2016. 5 minus 2 equals to 3 ringgit. This must be expressed in the functional currency of subsidiary, because these are subsidiary assets. After that, you must translate to presentation currency, do the usual step. All assets liability at the year end will be translated using closing rate. All income expenses will be translated using the average rate. Impairment is considered as an expense, a loss. This will be translated using average rate. The year-end figure for goodwill is an assets. Assets will be translated using closing rate. The average rate for the year is equal to 1.88. The closing rate is equal to 1.82. Translated impairment loss should be equals to Hong Kong dollar is 3.8. The translated goodwill at the year end is equals to Hong Kong dollar 5.5. Again, we have to calculate the differences. Balancing figure. 9.5 minus 3.8 equals to 5.7. After translation from functional currency to presentation currency, the goodwill is only 5.5. There's a drop of 0.2. This represents a loss. Because it's a drop to the assets, it's a loss. So this represents a translation loss. This is the loss. Next year may be a gain or loss. This translation loss is just a difference we put in OCI, 0.2. We have to adjust from 9.5 to 5.5. There are 2 adjustments. The first adjustment is impairment loss. Impairment loss of goodwill always go to P&L and cannot be reversed, can never be reversed. Translation loss go to OCI. Translation loss, this is a loss, next year may be gain or loss. These differences will be put in OCI. Put this adjustment in our worksheet. There should be impairment loss to P&L 3.8, the translation loss is 0.2, goodwill is adjusted down by 4. Take this column, plus minus equals to the answer here. This entire process. When you do this consolidation adjustment, I keep telling you, you must have a set of working. Let us use the working that we use all the while. We need to know what is BBL net assets. Year end is 31st December 2016. We need to know what is the net assets on this date is equals to equity. The share cap and the retained earning. The share cap is equals to ringgit 20. Retained earning at the year end is equals to ringgit 80. This represents the net assets at the year end, 100. The next step is to move back to the acquisition date to calculate the pre. This acquisition was on 1st Jan 2016, acquisition date. At the acquisition date, the share capital is 20. The retained earnings is equals to 70. This represents the pre and we have the post. Post for current year, 12 months. We add it up is equals to ringgit 90. At the acquisition date, there's a plant assets, 15 ringgit. After the acquisition date, the post profit is equals to 10 ringgit profit loss. We increase the value of the plant. You must also increase the depreciation of the plant. And the remaining is 5 years, 15 over 5. Every year we must account for $3 of depreciations. At the end of the first year, the remaining plant assets is equals to 12 ringgit. And how we calculate goodwill? The cost of investment is equals to 110. That's a cost minus the total of these two. The goodwill is equals to 5 ringgit. The goodwill is over here. The cost of investment is 10. Share cash 20, retained earnings 70, plant assets 15. The fair value asset is equal to 105 minus equals to goodwill. For this question, there's an impairment of goodwill is 2 ringgit. At the year end, the goodwill is equals to 3 ringgit. This is a figure that we discussed earlier on. All this in ringgit. We have to translate this to Hong Kong dollar. At the acquisition date, the exchange rate is equal to 1.9. The average rate for the year is equal to 1.88. And the year end, the exchange rate is equal to 1.82. At the acquisition date, for the year, and at the year end. We can apply the exchange rate. $20 multiplied by 1.9. Earlier we calculated when calculate goodwill, the same figure. I just repeat myself over here just to make sure that you know what's going on. The share capital is equals to 38, 1.9. The retained earning at the acquisition date is equals to 133. Plant assets at the date of acquisition is equals to 38 plus 133 equals to 171. The plant assets is translated the first time using 1.9 equals to 28.5. The goodwill translated the first time equals to 9.5. These are the figures that translated. Share cap, retained earning, the net asset translated, the plant translated, consolidated, the goodwill calculated and consolidated. The profit for year, the $10 is to translate using 1.88 equals to 18.8. The depreciation is translated 1.88 also equal to 5.6. The impairment is translated 1.88 also. The impairment goodwill that charged to profit and loss is equals to 3.8. At the year end, the assets liability will be translated using the closing rate equals to 1.82, 182. Plant assets have a balance of 12, translated using 1.82 is equals to 21.8. The goodwill translated at the year end based on 1.82 equals to 5.5. These are the translated amount. Now we have to calculate a balancing figure. Take this minus this. There should be a difference. 171 plus 18.8 minus 182. There's a difference of minus 7.8. This represents the translation loss. Is this amount 7.8? The same 7.8 but calculated differently. The translation differences on plant assets, add out these two, calculate the balancing figure. 28.5 minus 5.6 depreciation minus closing balance, there's a difference of minus 1.1. This 1.1 is a translation loss. Add out these two, minus this, there's a difference. 9.5 minus impairment loss 3.8 minus the closing balance, there's a difference of a loss 0.2. These are the translations differences. These translation differences, this is the loss next year may be gain or loss. This will be placed in OCI. You can find these three figures on the worksheet. Over here, 7.8, 1.1, 0.2. Total is 9.1. This is the working that we have been using from day one. The only difference is that when we're dealing with foreign operations, we still have to consolidate in this case. But before we consolidate, we must do translations. After that, then we do consolidations. Translation is the additional step. Let me put this in the diagram. AAL, investment in BBL. At 1st Jan 2016, the net assets is ringgit 90. We have to increase this by 15 because of the plant assets. As a result, it's equals to 105. Parent own 100% at the cost of ringgit is equal to 110. In this case, there's no NCI. Take the 110 minus 105. So there's a goodwill of 5 ringgit. We have to increase this 105 by profit 10 ringgit. And we must account for depreciation of 3 ringgit. The adjusted net assets will be equals to 105 plus 10 minus 3 equals to 112. And the goodwill we mentioned that we have to minus impairment of 2 ringgit. At the end of the day, the goodwill is equals to 3 ringgit. When there's adjustment, you plus minus in the functional currency of subsidiary. After that, we must translate this to the presentation currency. These are the assets at the year end. These are the goodwill at the year end. It will be translated based on the closing rate. Multiply 1.82 equals to $203.8. Goodwill is equals to 5.5. Can you find this figure in our working? Definitely you can. It's the total of these two. 203.8 and the goodwill is 5.5. 203.8, 5.5. 203.8, 5.5. If you observe carefully, you can see when translate the plant assets and the goodwill, the steps are the same from functional currency to presentation currency. At the acquisition date is translated using the HR rate. Any adjustment during the year is translated based on average rate. The balance is translated based on closing rate. Balancing figure is the exchange differences. Apply the same approach to goodwill. At the date of acquisition is translated using HR rate. Impairment goodwill is translated based on average rate. closing balance of goodwill is translated using closing rate. After that, calculate the balancing figure. By doing this, or by doing this, or by doing this, all are the same. I just present the figure differently using the same principle. For this question, it's straightforward because it's 100% owned. If this question is not 100% owned, for example, it's 80% owned, that means there's this party called NCI, 20%. What does 20% NCI means? Assuming you is the shareholder of this company, 20%, what do you share? You will definitely share these net assets. But do you share these assets goodwill? Depending whether this goodwill is a full goodwill or partial goodwill. If it's a full goodwill, NCI have a share. If NCI share the adjustment, including translation differences. If it's a partial goodwill, NCI do not have a share. If NCI do not have a share, NCI do not share the adjustment. Can refer to notes. Foreign operations, translation of goodwill and fair value adjustment. Question will be different. The principle will be the same. So you need to apply the same principle into different questions. Any goodwill or any fair value adjustment relating to the assets liability of the subsidiary, it belongs to the assets liability of subsidiary. They are treated as adjustment to the assets liability of foreign operations. It must be expressed in the functional currency of the foreign operation. That means when there's any adjustment, you must adjust in the functional currency of subsidiary first, or associate. So far just now I talked about subsidiary. It's the same applicable to associate. After adjustment, then we do translation to presentation currency. This is in the functional currency of the subsidiary. If there's any adjustment, you plus minus adjustment first. After that, then we talk about translation to presentation currency. The first time we do translation is based on HR rate. Any income expenses will be based on average rate. The closing assets liability will be closing rate. Calculate the balancing figure is the translation differences. This working here applicable on goodwill and also applicable to any PPE assets or deficit. For foreign operation, there are subsidiary that not 100% owned, which means there should be NCI. If NCI share the net assets, NCI will share the translation difference on net assets. If it's a full goodwill, NCI share the full goodwill, NCI will share the translation differences on goodwill. If it's a partial goodwill, NCI do not share the partial goodwill, NCI will not share the translation differences on this partial goodwill. Please refer to page 75. Question 1.6 is a Module A questions. This question is to discuss the translations of the financial statement of foreign subsidiary. Thereafter, we will use the translated financial statements to prepare the consolidated financial statements. Study the questions, understand the issue. We will discuss this question shortly. Assuming you are accounting manager Lee, you are required to prepare a memo to Director Chow. In your memo, you should calculate the total translation reserve to be presented in the consolidated financial statements at 31st December 2012. That is considered the year end. 40 marks. The question mentioned that you may consider analyzing the translation reserve on net assets, fair value adjustment, and goodwill, or using other presentation method to calculate translation differences. If you come across this type of statement when they say you may, in exam is you must. By giving you this sentence is to tell you you should do this. These are hints given from the examiner. When the question says you may do this, in the exam you have to do so. Because the marker will be given the similar working, when your working match the marker working, it makes it easy for the marker to mark the paper. For part A, when you calculate the translation differences, you must analyze the translation differences on net assets, fair value adjustment, and the goodwill separately. Part B, you are required to prepare the worksheets for the consolidated statement of financial positions at 31st December 2012. For this question, we are required to account for deferred tax at the relevant tax rate. Notes number 5, there was no impairment goodwill. Number 6, the relevant Australian corporate tax rate is 30%. We must take notes. If there's any fair value adjustment, we must take the 30% to calculate deferred tax. One of the directors, Chow, queried that there is an item of translation reserve appear in the consolidated financial statements, though it is not recognized in the individual financial statement of the parent and subsidiary. Director Chow is finding difficult to obtain the figure in the condensed consolidated financial statement. Your job is to answer Director Chow's query by showing the detail of the translation differences and prepare the adjustment entry on the worksheet. Referring to the question, assuming that you are Ms. Lee, the accounting manager of MHL, a company incorporated in Hong Kong, functional and presentation currency is Hong Kong dollar. On 31st December 2011, MHL acquired 80% of ordinary share of STL, which is located in Australia. At the date of acquisitions, STL share capital is 24 Australian dollar and retained earning is 30 million Australian dollar. This is share cap, retained earning. MHL acquire STL 80%. The functional currency presentation currency of MHL is Hong Kong dollar. How about the functional currency of STL? Referring to notes number 3, the Australian dollar is the currency of primary economy environment in which STL operate. Therefore, functional currency STL is considered as Australian dollar. Subsidiary have a functional currency of Australian dollar. In this case, we say that with control, you must consolidate as a group at 100%. We cannot just add 100% because we cannot add out Hong Kong dollar with Australian dollar. We must translate from Australian dollar to Hong Kong dollar. STL is considered as foreign operations. And do not forget with this party called NCI of 20%. So this is a group structure. We have to do translations and then we do consolidations, 2-step, because this is considered as a foreign subsidiary. STL is considered as a foreign subsidiary. 80% give us control. 31st December 2011 is the acquisition date. We are given the statement of retained earning for MHL and STL for the year end 31st December 2012. We are also given the statement of financial position of MHL and STL. Earlier we concluded that STL is considered as a subsidiary. We must do 100% consolidations. But before we can consolidate, we must translate from Australian dollar to Hong Kong dollar. This translation is from functional currency to presentation currency. These are all assets should be translated using the closing rate. These are the liability will be translated using closing rate. For equity, we need to split between pre and post. For pre will be translated using the HR rate. Referring to the exchange rate given to us below, MHL acquired STL on 31st December 2011. The exchange rate is 7.6. This represents the HR rate, exchange rate at the day when parent obtained control. The exchange rate on the first day we do translations. This is exchange rate at the end of the year, 31st December, 8.1. This 8.1 represents the closing rate. We're also given the average rate for the year is 7.8 average rate. The assets liability will be translated using the closing rate 8.1. The HR rate is equals to 7.6. The post referring to the post profits to be translated at average rate is equals to 7.8. We need to know what's the investment cost recorded by MHL in STL. Referring to the statement of financial position of MHL, we should be able to see this item, investment cost of STL, 427,500. But this 427,500 is in Hong Kong dollar. We need to know how much the parent paid to acquire subsidiary at the acquisition date in Australian dollar. We know the exchange rate when the parent acquires subsidiary is 7.6. This is the HR rate or the sports rate. Just need to work backward. You have to take 427,500 divided by 7.6. The Australian dollar is equals to 56250. This investment cost of 427,500 is recorded at sports rate, that means the HR rate. In Australian dollar term is 56250. We need to know this because we have to calculate goodwill. The book value of STL assets liability approximate to their fair value asset for a patent, intangible assets, whose fair value was greater than book value by $10 million at 31st December 2011. We need to increase this by $10 million. This increase is considered as a pre-adjustment. The patent have a remaining useful life of 10 years from 31st December 2011. We increase the value of the patent after the acquisition date. We must also increase the amortizations of the patent. The useful life is 10 years. Every year the amortization should be equal to $1 million. The acquisition date is on 31st December 2011 to now is 31st December 2012. So we must do 1 year of amortization adjustment. After accounting for the patent assets and the amortizations, do not forget we must account for the deferred tax effects. The deferred tax effects will be at 30% in this case. NCI is equals to 20%. If parent own 80, NCI will be 20%. Measured at proportionate share of the acquired identifiable net assets. If the NCI is measured at proportional share, the goodwill will be considered as a partial goodwill. If it's a partial goodwill, NCI do not share this partial goodwill. Along the way, when there's any adjustment to this goodwill, NCI do not share this adjustment. If NCI do not share this partial goodwill, NCI will not share this adjustment because it's a partial goodwill. Over here, we're required to prepare a memo. To make sure you have proper memo format, to Director Chow from you, Accounting Manager Lee, the dates, the subject. There are 2 issues you have to consider, translation differences, and the worksheet for the consolidated statement of financial positions. A simple introductions, and you must have a closing. The first issue you have to consider is to calculate the translation differences. We discussed in the earlier session that translation differences on the foreign operation, there are 2 translation differences. One is translation differences on net assets, one is translation differences on goodwill. In the exam, normally I urge candidate to do the easy one first. This is the easy one. All assets liability will be at closing rate. All income expenses will be at average rate. Equity at the acquisition date will be at HR rate. And after that, you must calculate the balancing figure plus minus. Now I take this column out as working. Translation of the net assets of STL. This translation is from functional currency to presentation currency. All assets liability will be translated using closing rate. The pre will be translated at HR rate. The profits will be translated using the average rate. This column is from the questions. Now we have to do translation. Obviously, we need to know what exchange rate to apply. All assets liability, all this will be using the closing rate. Equity at the acquisition date represent the pre. This is a figure that we first translate when we calculate goodwill. And the profit for a year will be translated using the average rate. The positive represent debit. The negative represent credit. This is positive, 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 positive. This is negative, negative. If you add up this column, there should not be any differences. Now you add up this column, there is a translation differences of 30. This 30 is a credit balance. If it's a credit balance, it represents a translation gain. This is translation gain on the net assets of STL. Total translation reserve. First, we look at translation differences on the net assets of STL, the financial statement of STL. And after that, we must consider the fair value adjustment. In this case, the fair value adjustment is relating to patent and the deferred tax liability. After that, we must consider the translation differences on goodwill. Based on calculation, we mentioned that the translation differences on the net assets of the subsidiary before consolidation adjustment is equal to $30 million. This $30 million is a gain. Now, we have to calculate the translation differences on goodwill. Before we can calculate translation difference on goodwill, we must calculate goodwill first. This is the translation differences on goodwill. When we say goodwill of STL, it must be expressed in functional currency of STL. The cost of the 80% is not given, but earlier we calculated in functional currency STL is equals to Australian dollar 56250. Then we must account for NCI of 20%. NCI is a proportionate share, so we'll come back to this later on. We have to consider the fair value net assets of the subsidiary, STL. The fair value net assets of a subsidiary normally is represented by the share cap, retained earning, and for this question, we have a patent assets, and because of patent assets, we must account for deferred tax liability, 30%. As given the question, the share capitals of the subsidiary is equals to 24. The retained earning at the acquisition date is equals to 30. The patent assets, $10 million. Take 10 multiplied at 30% equals to deferred tax liability of 3. If there's any other adjustment, plus minus. If not, add it up. So in total, it's equals to $61 million. This $61 million represent the net assets of the subsidiary at the acquisition date. This will be 100% consolidated. We do not own 100%, so the portion we do not own is the NCI. Take 20% multiplied by this figure, because NCI is a proportional share. 20% multiplied by 61, the NCI is equals to Australian dollar 12200. Now we can calculate goodwill at acquisition date. 56250 plus 12200 minus 61000. The goodwill at acquisition date is 7450. When we calculate goodwill of the subsidiary, this must be expressed in the functional currency of the subsidiary because it's an asset of subsidiary. Now we have to translate from functional currency to presentation currency of the group. Presentation currency of the group is Hong Kong dollar. This figure are figure that at the acquisition date, the figure we used to calculate goodwill for the first time, all this figure will be translated using the HR rate. The HR rate is equal to 7.6 multiply equals to Hong Kong dollar 427,500, Hong Kong dollar 92720. Share capitals translated, consolidated, and eliminated is equals to 182,400. Retained earning at the acquisition date translated, consolidated, eliminated is 228,000. The patent assets translated, consolidated is equals to 76,000. Because of this patent assets, we must account for deferred tax liability of 22800. Goodwill is the balancing figure, equals to Hong Kong dollar 56620. This column represents the presentation currency, translated amount. This goodwill is the net of these, is also equals to 7450 multiplied by HR rate equals to 56620. Either you use these or use these, you get the same answer. This goodwill is the goodwill at the acquisition date. If there's any impairment loss, when we calculate impairment loss of goodwill, we should be taking this figure and we should not be taking the translated amount. The goodwill expressed in the functional currency of the subsidiary is 7450 minus any impairment loss. If there's no impairment loss, just need to add it up. This will be the carrying value at 31st December 2012. Is equals to 7450. No adjustment. Now we have to talk about translations. Goodwill initially is translated at HR rate. If there's any impairment is an expense, it will be translated using the average rate. Goodwill at the year end is an assets will be translated using closing rate. This is the basic concept. Can we apply the exchange rate here? If there's any impairment, will be translated using 7.8. Goodwill at the year will be translated using the closing rate 8.1. There's no impairment loss. If there's any impairment loss, you minus. 7450 multiplied 8.1, the goodwill is equals to 60345. The goodwill at the acquisition is translated using 7.6. The same amount of goodwill at the year is translated 8.1. The goodwill is the same, but the exchange rate is different. As a result, there's a translation differences. At the start, the goodwill is only 56620. At the year end, the goodwill is equal to 60345. The goodwill increased by 3725. This 3725 represents a translation gain. Assets value is higher, so it represents a gain. This translation gain should be recognized in OCI, but bear in mind, if there's any impairment loss, the impairment loss must be recognized in P&L. This is a figure that we need, 3725. The translation differences on goodwill is 3725. And now we have to calculate what's the translation differences on patent and deferred tax liability. These are assets liability of the subsidiary. Earlier on we calculate goodwill, we look at patent. The patent initially is translated using 7.6. Take the patent down, patent assets. The patent assets must be expressed in the functional currency of the subsidiary. At the acquisition date, the patent assets is equals to 10 million Aussie dollar. Initially, it's translated in presentation currency at 7.6, the HR rate, which is Hong Kong dollar 76,000 dollar. The patent have a remaining useful life of 10 years. Every year, we must account for amortizations to profit and loss. $10 million over 10 years account for $1 million amortizations. When we make adjustment, we must adjust in the functional currency of the subsidiary. The carrying value of the patent at 31st December 2012, there's a remaining 9 million Aussie. When we talk about adjustment, it must be in the functional currency of STL. Now we talk about translation into presentation currency. Amortization is an expense. Expense will be translated using the average rate. Patent at the year is an assets. Assets at the year will be translated using closing rate. Applying the exchange rate, average rate for the year is equal to 7.8. The closing rate at the year end is equal to 8.1. The translated amortization charge to P&L will be equal to 7,008. The translated patent assets remaining at the year end, 9,000 multiplied 8.1, is equals to 72,900 Hong Kong dollar. So after that, we have to calculate the balancing figure. 76,000 minus 7,008 minus 72,900. There's a difference of Hong Kong dollar 4,007. After translation, assets value is higher. When assets value is higher, this represents a translations gain. This gain will be recognized in OCI. This is the figure that we need to calculate, 4,007. As a result of the patent assets, we must account for deferred tax liability. At the acquisition date, we account for deferred tax liability of 3,000, translated as 7.6. Can I take this down to show as a separate working? We do have a deferred tax liability as a result of the patent assets. It must be expressed in the functional currency of the subsidiary. At the acquisition date, we account for deferred tax liability of 3,000 Aussie dollar. And this 3,000 is first translated in presentation currency at HR rate, which is equal to 7.6. Translated amount is equals to Hong Kong dollar 22,800. I put as a minus because it's a liability. As a result of the patent amortizations, we lower the taxable differences. As a result, we should lower our deferred tax liability, transfer this to P&L as a tax adjustment. This is a tax adjustment in profit and loss. Taking 1,000, multiply a tax rate of 30%. The deferred tax adjustment is equals to 300. Thereafter, this will be the carrying value of the remaining deferred tax liability at the year end, a minus of 2,007 Australian dollar. We must translate from functional currency to presentation currency. This tax is a tax adjustment to the income expenses. This will be translated using the average rate. The deferred tax liability at the year end will be translated using the closing rate. Applying the exchange rate, the average rate for the year is equal to 7.8. The closing rate at the year end is equals to 8.1. 300 multiplied 7.8 equals to 2340. The closing deferred tax liability is 2,007 multiplied 8.1. Deferred tax liability at the year end remaining is equals to 21,870. Now we have to calculate the balancing figure. 22,800 minus 2340 minus 21,870. There's a difference of 1,410. Liability is higher. This is considered as a translations loss. This translation loss will be recognized in OCI. This is the exchange differences that we need. The translation differences on the assets is equals to 4,007. The translation loss of the deferred tax liability is 1,410. 30,000 plus 4,007 minus 1,410. The total translation differences is 33290. And the translation gain on the goodwill is equal to 3725. Total is equals to 37015. These translation differences will appear as part of OCI. How much do we let NCI share? 20%. NCI always share the net assets of subsidiary. So NCI will share the translation differences of the net assets of subsidiary. NCI will share this amount 20%. 33290 multiplied 20% is equals to 6658. Does the NCI share this goodwill? Answer is no, because this is a partial goodwill. If NCI do not share the partial goodwill, NCI do not share the translation differences on goodwill in this case. NCI do not share. In total, the NCI share of the translation differences is 6658. The amount that belongs to the parent is the balance. We take this amount minus this, equals to 30357 This represents parent shared, so this was part of the translation differences reserve account. Part B will require to do the worksheet. Your job is to fill in this column and put in the adjustment entry. The objective of going through this worksheet is to have an overview and better understanding on the translation process so that you can explain the issue in the exam for Module 11. Again, please take note that those figures in credit are shown in bracket. For example, share cap, retained earning, translation